Well, good morning, everyone, and a very warm welcome to this WCM advisor briefing. My name is Damien Craven, Head of Retail at Contango Asset Management, and I must say on behalf of Contango, we are delighted to have the exclusive distribution arrangement and relationship with WCM Investment Management out of Laguna Beach in California. Joining me today from Laguna Beach, and a cold day in Laguna Beach today, is John Tringale. John, apart from being an incredibly gifted golfer, I'm hearing, is also client portfolio manager at WCM. Welcome, John. Thanks for joining us.
My pleasure. Thanks for having me.
Thank you so much. John, we've got two structures available here for the WCM Quality Global Growth strategy that you provide for us. Both one's a listed investment company and an exchange-traded managed fund. Now, I'm sure all of our listeners hear from managers all the time about their unique investment approach. What makes WCM's investment approach unique?
Well, there's really quite a few facets, but I think one of the most unique components or aspects is how we look at competitive advantages a bit differently, I think, than a lot of other managers and really than the market. And I think it's born out of this idea that Warren Buffett really popularized many, many years ago, this notion of buying a high quality business with large competitive advantages or a wide economic moat, as he likes to use the metaphor. And of course, you're trying to buy that business at a discount to its intrinsic value. Now, we're of the view that 30 years ago, there was probably a lot of low-hanging fruit in the marketplace by investing that way, by just buying a high-quality business with a big moat cheaply. In today's world, though, you have so many smart people around the world trying to do that same thing, that there probably aren't a whole lot of inefficiencies to exploit. And worse than that, we believe that type of thinking can lead you to value traps, where you invest in these companies that have large moats, and you buy them because they're cheap, but they're ultimately cheap because they're getting disrupted and they're going to keep getting cheaper, and you end up destroying huge amounts of capital. So I think that's one flaw with conventional methodology. I think another is you tend to miss some of the great emerging growth stories because maybe they don't, when they're earlier in their growth stage, meet some of that criteria of conventional quality, which is low or no debt, high returns on capital, high profitability. If you think about a Google or an Amazon in its earlier days, it maybe didn't meet those conventional standards. So that leads me to our approach, which is a bit different, and we spend most of our time studying competitive advantages, but we do it from the lens that they're very dynamic in nature. Any business we look at in the world is either getting stronger or weaker vis-a-vis its competitors, and our goal with this portfolio is to fill it with 30 to 40 businesses where we can make a really compelling case that their competitive advantages are actually increasing. And as we look out, 3, 5, 7 years into the future, the economic moat, if you will, is going to be larger than it is today. And there's a lot of overwhelming evidence and data to suggest that what really drives stock returns is that change in competitive advantage, not the absolute size. So I think that's the first part of how we look at things differently. And I think second to that is the emphasis we place on corporate culture and the role that a really strong, healthy culture that's aligned with the competitive advantage of that business can help them keep growing that lead on their peers for much longer than the market gives them credit for.
Great, John. Thanks so much. And in terms of the sustainable competitive advantage or the wide economic moat, do you have an example recently of a company that you've looked at or sold or positioned in the portfolio that highlights that?
Yeah, I think just to take a step back, I think our philosophy around moat change is really helpful to get in front of great growth ideas that we want to own for the next 5 years or more. But I think when you think about things like capital preservation and downside protection, our methodology has helped even more on the avoid side and the sell side. I think that's probably our biggest challenge as a growth manager is when do you sell a stock? Because you buy a business, it does well, but you don't want to flinch at shadows and get out too early if there's a lot of runway. But if you overstay your welcome, these tend to be growth businesses with higher multiples. If the business stops getting better, you risk destroying a lot of capital. So a recent example that comes to mind, in the first half of this year, we exited Facebook after owning it for a number of years. We sold it back in May, and we had really come to the conclusion that the moat was no longer expanding. I think when you looked at consensus expectations around digital advertising, it was kind of very well understood that there was this emerging global duopoly between Google and Facebook. I think if you look at Facebook, the core engagement with their users in the key markets had really been on a negative trend. When you think about places like the US and Europe, we've seen that core audience engaging less and less. And I think they're going to be facing more competition with Amazon getting into digital ads and some other upstarts as well. That not that it's a completely broken business, but we certainly can't make the case that it's getting better versus its peers. And so we chose to exit.
Great, thank you, John. It's nice to see over your right shoulder there the fitness regime of the staff there at WCM, on someone on the bike pushing really hard.
Yeah, I think that.
So, John.
Go ahead.
Sorry, go on. So I might just come back to this culture piece. So it's a nice word, it's a buzzword. It's kind of everyone wants to have a good corporate culture and wants to be in a company that has a focus on culture. How did you get to that? And what's the experience within the business that led you down the path of recognizing that corporate culture was really important in the investment process?
Yeah, it really started with our own experience here at WCM and primarily Kurt Winrich and Paul Black, who are our two co-CEOs. They worked at WCM in the 80s and 90s when it was owned by one individual. And it was an old kind of sleepy high net worth shop back in the days from 1976 when it was founded until 1998 when they bought it out. And for that 22-year period, which was really a golden age to launch a money management firm following the ERISA laws in the US, they never got above 200 million in AUM. And Kurt and Paul believe that was due to the culture. You had one individual who made all the decisions, controlled all the equity. He could attract talent, but they would come in and see they couldn't really make a difference, couldn't make an impact, couldn't have growth, and they'd walk right out the door. And in fact, there were a couple of individuals who had worked here and went on to start firms that were much more successful than the old WCM. So in 98, Kurt and Paul bought out the firm and really decided that if they wanted to build a firm that could endure and do well over time, they had to build a culture that could attract and retain talent. They had to give people the opportunity to make a difference. I think that's a kind of fundamental human need we all have, is feel like we can make a difference. Be transparent, have good candor, pay high performers well, spread the wealth. So there's 28 of us here at the firm that are shareholders in WCM, and so with a lot of those changes, we've built a much had a lot more success than before. So we really came to this idea that if culture matters for us, it probably matters for all businesses. Not to say they should have a culture like ours. That is certainly not the case. Really, the lens we're looking at it is, what is the competitive advantage of this business? What is the business model? And does the corporate culture support it? Because at the end of the day, corporate culture is really a set of values that drives behavior. It's really those behaviors that are key. And so depending what the objectives of your business are, you need to incentivize those proper behaviors. So for example, we look for very different things in a retail culture than we would a cost-driven culture or a low-cost provider or an efficiency-driven business like a Canadian National Railway. We're looking for very different things.
And John, just to flesh that out, I'm reminded of a story that Kurt told us when he was here out last about the difference in culture between Costco and Sam's Club.
Yep.
Both exactly the same businesses, exactly the same business model. Just give us an example of the difference between someone with a good corporate culture who focuses on that and someone who doesn't.
Yeah, so since Kurt's already mentioned Costco and Sam's, I'll mention another example. And I think, where you see most obviously where culture makes a difference is you have two businesses in the exact same industry in the same market with the same model, but the financial metrics are so drastically different, and one is vastly superior than the other. And in many instances that we've studied over time, they can endure that advantage for a long period of time. So one name in the portfolio that maybe people aren't real familiar with is a company called Amphenol, which is arguably one of the strongest, best run companies that we've come across. and they compete with a company called TE Connectivity, and they basically just make little connectors that connect, semiconductors and different technology pieces, and everything from phones to computers, anything that uses semiconductors and technology. And they've got an extremely autonomous culture. Their headquarters in Connecticut, I think they have 60 employees. They have 85 different business units around the globe, and they give the manager of those full autonomy. And so what we saw, for example, in like a 2008, 2009, when semiconductors can be cyclical, when they start to see slowing demand, they can really have a lot direct control over their investment, their staff, their spending. They can be very nimble and shift as the market moves. Whereas we look at their competitor, TE Connectivity, much more bureaucracy, many more layers, very slow to change. And they had to, they ended up laying off many people and underperformed drastically in 2008 and have never really recovered to the same level where Amphenol has been able to compound growth during that same period. So I think one of the beauties, if you can get that culture piece right, is it's an advantage that's very hard to change. It's hard. It takes time to turn around an underperforming culture. It can be done, but it's not an overnight change. And the businesses that really have that ingrained can endure that advantage for longer.
Sure, and I'm sure that there are different examples of what you've come up with in your investment process or in the research that's highlighted. A step further with that too, John, there's a chief culture analyst within the investment team.
There is William Horner. I think there probably aren't a lot of firms you've come across that have a dedicated chief culture analyst. His job is really exclusively to understand the DNA of these businesses that we're following. And we intentionally keep him away from Bloomberg, keep him away from stock charts. We want him to be as unbiased as possible and not think, oh, this company's been performing well, they must have a good culture. So really how we utilize him is pretty late in the process. When we're getting close to, maybe making an investment in a company, the lead analyst has already done some preliminary culture work, but William will then come in and he'll conduct, anywhere from probably 10 to 15 interviews with former employees, with customers, suppliers, industry consultants who have been in the space for 30 years, and try and piece together this mosaic of, what drives this business. We also have a list of about 10 culture questions that we'll try and sit down and ask the CEO of these businesses. And this is a list of questions we've come up with that's designed to get the CEOs off script, because we've learned many years ago that if you just ask a company to tell you about their culture, you don't get to be a CEO without being a really good salesperson. And they're slick. They can usually roll off something, but it's completely useless from our standpoint from investing. So we try and get them off script and get about an hour with them, and then again, just it's a lot of work and talking to a lot of people and trying to piece together as best we can what this organization is all about.
Great, thanks so much, John. Insight into the investment process and philosophy of the not only the business but the strategy. In terms of macro, there are a number of macro commentators or macro people around who make predictions. What's your focus on macro as a firm?
Well, I would just say the adage around here is that if you're going to make predictions, you ought to make a lot of them because maybe you'll get one right. So suffice to say, we don't believe that anyone can consistently predict the macro, and to have that play an important role in the investment process, you've got to make a cascading number of correct decisions about when's something going to change, how's it going to affect the fundamentals, how's the market going to react, and to do that consistently, we just think is a low return on time exercise. So we're focused more, rigorously bottom up. Where are great businesses and great management teams that we can trust to navigate different economic environments? If you look at our track record and being able to perform in some tough market environments like 2008, and then also make the turn and do well in 2009, a lot of it has to do with that idea of owning companies that are growing their competitive advantage, because we found that they can go on offense when maybe it's the macro, you're having a downturn, the companies that are weaker, maybe they're just trying to stay afloat, just trying to make debt service. These companies can go on offense and invest in growth for when things turn, and we've seen that play out in a number of cycles. So that's really our focus. The one area we do use the macro is if there's a part of the world, whether it be a country or a region or a sector that is totally unloved, out of favor, hated, that tends to pique our attention. There's definitely a contrarian mindset here at the firm. So, for example, in the summer of 2015, the most hated market in the world was probably Brazil. You had unemployment skyrocketing. The real was just getting crushed. These businesses were really struggling. So we had originally planned a team trip to China, and we called an audible and went down to Brazil, met with about 15 companies, 12 of which just complained and whined about the macro. I can't grow my business in this environment. But there were a few businesses we met with that were taking initiative, going on offense, really felt a big opportunity in front of them. And one such name that we ended up buying from that trip was Mercado Libre, which has served us very well. So we will maybe use it in a contrarian sense, but we don't tilt the portfolio based on some macro view.
Great. And I should make mention, I've been thinking about doing it 3 or 4 times now. There is the opportunity for the attendees to ask any questions, so type them into your panel there, and we'll get to them just at the end. John, you did mention downside protection and 53% downside protection for the strategy since inception's really quite impressive, with the ability to only go to 7% cash. So congratulations on that. But so obviously the bottom-up stock picking, the avoidance of those companies that are declining in their competitive advantage is the key. How has that gone recently in the last couple of months of volatility? Where has the portfolio been at in terms of the downside?
Yeah, we've hung in there pretty well. So for the year to date, or I'll just say for the third quarter, because October was a very volatile month, and so quarter to date we're actually more than 100 basis points ahead of the benchmark, which we're encouraged by. I think that we're also seeing, as earnings season has been underway, the fundamentals of most of the businesses in the portfolio continue to perform nicely. And even though there was a sharp sell-off in some of them initially, we've seen some nice bounce back as folks get their pencils out and start, taking a harder look at the fundamentals and the prospects again. So it's a short period of time, so it's tough to draw too many conclusions from a couple months. But we have endured this latest bout of volatility relatively well.
Okay. And in terms of the portfolio positioning for the next 12 months, the next quarter to next 12 months, how are you seeing the portfolio in terms of its positioning and the conversations that you guys are having in your investment committee?
Yeah, so we continue to have the biggest exposure and biggest overweights in healthcare and technology. Just bottom up, what we're looking for at the end of the day is we're looking for businesses that have some type of tailwind to drive structural growth in their end markets. That's price of admission to look at an idea. And then we're looking for this growing competitive advantage and a supportive culture. And we tend to find businesses with those characteristics most commonly in the conventional growth sectors, like technology, like healthcare, a little bit in industrials, and not so much in the more cyclical, less predictable parts of the market, like financials, energy, commodities. So we have these kind of perennial underweights to those more cyclical parts of the market and overweight more tech and healthcare. I do think it's worth noting, maybe touching on the type of exposure we have within those sectors, because there are a lot of different headlines and potentially changes in healthcare when you think about pricing pressure or reimbursement risk, particularly here in the U.S. So we've chosen to have our healthcare exposure not be large pharma companies. We've chose for it to not be biotechs with binary events where you're betting on an outcome of a drug trial. It's not predictable enough for us. Where we found really some great opportunities and that we think are have the advantage of being not that correlated to the market and the macro, have been in and are much more consistent and predictable, have been with companies that sell basic medical supplies, devices, and equipment. I think one of the really powerful trends and themes we're seeing around the world is growing healthcare spend, particularly in some of these emerging market countries with really large populations. Brazil and Indonesia, for example, have pledged to double the amount of their GDP they spend on healthcare. I was recently in China, and you talk to folks in the hospital system there, and you say, "Are you really going to be growing your spend, high teens for the next 5 years?" And they say, "Absolutely, we have to." So that's a trend and an opportunity we want to participate in, but we don't think the winners there are necessarily going to be the companies with the $30,000 drugs. We think they're going to be the companies that can sell cost effectively and good quality, the basic blood testing equipment, tools, devices, supplies that you're going to need at every hospital and outpatient facility. And so you'll see within our healthcare exposure, a lot of those kind of picks and shovels, we call them, plays on healthcare. And so that's one area that I think we've beefed up in the last 18 months.
And part of that picks and shovels exposure is the FDA approval of those particular drugs. If you need to, or you want to change to another provider, it's really quite difficult. You've got to go through the whole approval process again.
Yeah, and I think West Pharmaceutical we bought earlier in the year. It's personally one of my favorite ideas. So they're in the pretty mundane sounding business of pharmaceutical packaging. And I'm not talking, the cardboard box that pills come in. We're talking the glass vials, the stoppers, the syringes that extract the liquid from the test tubes. It's pretty interesting that West Products, they make about 40 billion components a year. They have 70% of the global market for this packaging. And as you alluded to, when we talk about competitive advantage and moats, this is one of the most incredible ones we've encountered, because when a drug gets approved, the actual specific product number from West or whoever the manufacturer is considered part of the drug, since it's in direct contact with it. And so if they want to change packaging suppliers, they actually literally have to do a completely new FDA clinical trial. And so, as you can imagine, it doesn't happen. And so that's a great place to start with the moat. And as you know, with us, we need to see that moat growing. And we see that growing as we have this move to more complex liquid biologics. You're seeing a lot more generics, and they require more advanced packaging that's much higher margin. And so the fastest growing part of West's product portfolio is also the most profitable. And we're seeing, again, this tailwind and trends towards these more biologics. And we're really excited about the future for them.
Yeah. Great. And is there any other company, John, that you guys have been speaking about recently that everyone's excited about?
I think Shopify comes to mind. This is a business that's in that higher growth portion of the portfolio. It's pretty early in its life cycle and its growth stage, and they fit an interesting niche in the market that we think is maybe underappreciated. So basically, they help small businesses access consumers. So they help them with their online shop, they help them with shipping, logistics, running the business, and going direct to consumer via e-commerce. And so I think most people just assume that, of course, everyone's just going to go to Amazon, or they're going to go to Mercado Libre, or they're going to go to Alibaba. But what we think is pretty interesting when you think about Amazon, and this has been worked for them, but when you think about their culture, what their focus is on, it's on adding as much value as they can for the end consumer. How can we get them the lowest prices, the fastest delivery, and so on? And it works great. But when you think about who's left out in that equation, it's the merchant. Because if I'm selling my product on Amazon, not only does Amazon control all the data around what people are looking on, what they're clicking, how my product looks, where does it come up in a search. On top of all that, they take a pretty hefty commission, typically in the 20% range, and that's consistent globally with the other large e-commerce players. And so for me, if I'm selling something, yes, maybe I'll do some of that to get out there and get exposure. But with Shopify, I control the look, I control the feel, I own all my own data, and they have a take rate on average, or a commission of about 1.4%, so less than a tenth. So really, they're obsessed with the merchant, and that's what they're all about. So when we think about how early they are in their penetration, they have maybe 4 or 5% of the market here in the U.S., almost nothing elsewhere, and they're really in the catbird seat to grow this direct-to-consumer movement globally with enterprise software type of profitability as they scale. So that's one we're pretty enthused about.
Sure. And John, you talked about an overweight position or exposure to technology, but the FANG stocks don't necessarily appear in the portfolio. There's a couple of them, but not a significant amount as you would expect. What's the technology exposure? What do you class in that exposure?
Yeah, so we've got about 24% of the portfolio in tech. We do own Amazon, although it's been a lower weight. We trimmed it pretty aggressively as it ran up last year. And we do not own any of the others presently. We have in the past, as I alluded to. But much of our tech exposure, again, we look for some of those picks and shovels. Technology is fast moving. These product cycles can be quick. There's disruption all the time. So we've opted for some of those picks and shovels, like a Taiwan Semiconductor, where we're not betting on who's going to have the latest and greatest new chip that's going to be in iPhone 11, but they're going to physically produce chips for the entire industry. And they're going to be, as a result, much more consistent and much more predictable and trade at a much more attractive valuation than maybe some of the chip designers. So we've chosen companies of the similar ilk for a good chunk of the tech exposure.
Sure. Thank you, John. I might just get through to the questions. If anyone's got any questions, please feel free to send them through. Vanessa, I'll get those culture questions through to you. One from Sean and Sam. Guys, thanks so much for the question. You mentioned, John, that you try and find a culture that suits the business needs. How do you determine the suitability of a good or improving culture and a bad or worsening culture?
Yeah, that's a great question and a key part of the formula, because like competitive advantages, cultures are also dynamic and shifting. And so, it's really, there's no simple answer. It's every year we're doing a full-blown thesis, deep dive thesis refresh on every business, including a cultural assessment. And so that's maybe the baseline. And then, when we'll do our next deep dive at a business, we'll start from scratch and we'll do those, 10, 15, 20 interviews with different individuals in the value chain again, and see if there's any clues to change. I think you can also look at other metrics like employee turnover. I think we pay close attention to how compensation incentives change. Those can give you clues. And of course, whenever there's leadership change, that prompts a kind of an investigation for us.
Yeah. Great. Well, if there's no more questions, John, we're just coming up on half an hour now, so perfect timing. Thanks again so much for your time, and I'm sure that we'll have some more queries and questions come through. As I said at the start, we're just completely delighted to have an agreement and relationship with the quality of WCM. Everyone's spoken to there. Everyone in the business has been very welcoming of us bringing the strategy to Australia, and we look forward to the new year. So thanks very much again, John, and really appreciate your time.
Yeah, feelings mutual. Thank you.
Good on you. Thanks, John.
Take care.
Bye, everyone. Any questions or any follow-up, please feel free to send them through to me. My contact details are obviously available, and look forward to hearing from everyone. And if we don't speak beforehand, have a fantastic Christmas and a very safe break. Thanks so much, everyone.